What if I told you that a janitor who never earned more than $25,000 a year died with $8 million in the bank? No lottery. No inheritance. No crypto gamble. Just one simple strategy that Wall Street doesn't want you to know about because it makes their jobs obsolete. His name was Ronald Read, and by the time you finish watching this video, you'll understand exactly how he did it, and why you can do it too, starting today with as little as $50. For decades, the investment industry has sold you a lie. They've convinced you that to build wealth, you need a financial advisor charging 2% fees, a stock-picking genius who can beat the market, or insider knowledge that regular people could never access. But here's the truth they don't want you to hear. The vast majority of professional investors, the ones in $1,000 suits managing billions of dollars, can't even beat a simple, boring investment strategy that requires about 15 minutes of your time per year. That strategy is index fund investing, and it's about to change everything you thought you knew about money. This isn't going to be another dry lecture about finance. This is the story of how ordinary people have quietly built extraordinary wealth while the financial industry tried to complicate something beautifully simple. This is about a revolution that started with one man's radical idea in the 1970s, faced massive resistance from the entire Wall Street establishment, and eventually became the secret weapon of millions of people who refused to play a rigged game. By the end of this video, you're going to understand not just how to invest with index funds, but why this might be the most important financial decision you'll ever make. Let me take you back to 1976. Disco is dominating the radio. Rocky is in theaters. And a man named John Bogle is about to commit what the financial industry considers heresy. Bogle has just founded a company called Vanguard, and he's preparing to launch something that's never existed before, the first index fund available to ordinary investors. The concept is so simple it sounds almost stupid. Instead of trying to pick winning stocks, just buy a tiny piece of every major company in the market and hold them forever. Wall Street absolutely hated this idea. They called it un-American. They said Bogle was settling for mediocrity. One prominent broker said investing in an index fund was like deciding to be average, and who wants to be average? But Bogle had discovered something remarkable in the data, something that would eventually win him enemies throughout the entire financial industry. He found that after fees, after taxes, after all the buying and selling, roughly 80% of professional fund managers failed to beat the overall market over the long term. 80%. These were the experts, the professionals, the people with teams of analysts and supercomputers, and they were losing to doing nothing at all. Think about that for a second. Imagine paying someone to fly your plane, only to discover that 80% of the time, the autopilot does a better job. That's essentially what was happening in investing, and nobody wanted to talk about it. The reason is obvious. There's no money in simple. Financial advisors can't charge you massive fees to tell you to buy an index fund and forget about it for 30 years. Mutual fund companies can't justify their 2% management fees when a simple index fund charges 0.03%. The entire industry's profit model depends on you believing that investing is complicated, mysterious, and requires expert guidance. But it doesn't. And that brings us back to Ronald Read, the janitor who died with $8 million. Ronald didn't have an MBA. He didn't watch CNBC. He didn't have a financial advisor. He just bought shares of solid companies and index funds, spent less than he earned, and let time do the work. While his friends were chasing hot stock tips and paying advisors to actively manage their money, Ronald was quietly, boringly, getting rich through the magic of compound interest and low fees. Now, before we go further, let me ask you something, and I want you to actually comment your answer below. What's the biggest thing stopping you from investing right now? Is it that you don't have enough money? That it feels too complicated? That you're afraid of losing everything? Drop your honest answer in the comments, because I guarantee whatever's holding you back, we're about to demolish that obstacle completely. Here's how index fund investing actually works, and I promise you'll understand this even if you've never invested a dollar in your life. Imagine the stock market is a massive garden with thousands of different plants. Traditional investing is like trying to predict which specific plants will grow the tallest this year. You hire expensive gardeners, fund managers, to study the soil, the weather patterns, the seeds, and make their best guesses. They charge you hefty fees for this service. And most of the time, they guess wrong. Index fund investing says, forget guessing. Instead, I'm going to plant a seed in every single plot in this garden. Some plants will die. Some will barely grow. But some will absolutely explode with growth. And because I own a piece of everything, I'm guaranteed to capture all that growth without having to guess which plants succeed. When the garden as a whole flourishes, I flourish. When Apple becomes a trillion-dollar company, I own a piece of that. When Amazon transforms retail, I'm along for the ride. When the next revolutionary company emerges that we can't even imagine today, I'll own part of that too. The most popular index fund tracks something called the S&P 500. This is simply the 500 largest companies in America. Apple, Microsoft, Amazon, Google, Tesla, and 495 others. When you buy an S&P 500 index fund, you're buying a tiny slice of all these companies in one simple transaction. One purchase. Instant diversification across the entire American economy. Over the last 100 years, despite wars, depressions, pandemics, and countless crises, the S&P 500 has averaged about 10% annual returns. Not every year. Some years it drops 30%, other years it soars 40%, but over time, the trend is unmistakably upward. Let me show you what this means in real numbers, because this is where your brain is about to explode. If you're 25 years old and you invest just $300 a month into an S&P 500 index fund, earning that historical 10% average return, by the time you're 65, you'll have $1.9 million. Read that again. $300 a month for 40 years equals nearly $2 million. That's less than the cost of a decent car payment. That's skipping a few restaurant meals and one streaming service. And it produces millionaire-level wealth. But here's where it gets even more beautiful: the power of starting early. If you start at 25 and invest until 35, just 10 years, putting in a total of $36,000, and then never invest another dollar, you'd have $1.2 million at 65. But if your friend waits until 35 and invests the same $300 monthly from 35 to 65, 30 full years, putting in $108,000 total, they'd only end up with $680,000. You invested a third as much money, for a third of the time, and ended up with nearly twice the wealth. That's compound interest. Einstein supposedly called it the eighth wonder of the world, and he wasn't exaggerating. Now, I know what some of you are thinking. This sounds too good to be true. What's the catch? The catches are actually not catches at all once you understand them. They're features, not bugs. First, this requires patience. You cannot get rich quick with index funds. You will see your account value drop sometimes by a lot. In 2008, the market fell almost 40%. In 2020, it dropped 34% in a month. If you panic and sell during these crashes, you lock in your losses and destroy the strategy. The people who got rich with index funds are the ones who kept buying during the crashes, who understood that these temporary drops are the price of admission for long-term wealth. Second, this is boring. Devastatingly, mind-numbingly boring. You're not going to have exciting stories at parties about the hot stock you picked that tripled. You're not going to feel like a genius day trader. You're going to set up automatic investments, ignore the noise, and watch your wealth slowly compound over decades. For some people, this boredom is torture. For wise people, this boredom is freedom. It means you can live your life instead of obsessively checking stock prices. And here's something crucial that trips up beginners. Fees matter more than almost anything else. A financial advisor charging 1% annually might not sound like much, but over 30 years, that 1% fee will cost you hundreds of thousands of dollars in lost compound growth. Traditional mutual funds often charge 1 to 2%. Index funds charge as little as 0.03%. That difference is the gap between comfortable retirement and extraordinary wealth. When John Bogle launched the first index fund, he wasn't just offering a new investment. He was declaring war on the fee extraction machine that had been quietly draining investors' wealth for generations. Let me share another story that'll crystallize why this matters. In 2008, Warren Buffett, one of the greatest investors in history, made a bet. He wagered $1 million that a simple S&P 500 index fund would beat a collection of hedge funds, the most elite, expensive, sophisticated investment vehicles in the world, over 10 years. 5 hedge funds accepted the challenge. These weren't random funds. These were the best of the best, managed by supposed geniuses, charging massive fees for their expertise. 10 years later, the results came in. The index fund returned 125.8%. The hedge funds averaged just 36%. It wasn't even close. The simple, boring, cheap index fund demolished the professionals. Buffett made this bet to prove a point. For the vast majority of investors, trying to beat the market is a fool's errand. Even the professionals can't do it consistently. Your brother-in-law who brags about his stock picks definitely can't do it. The YouTube gurus promising to teach you their secret trading strategy can't do it. But you don't need to beat the market to build wealth. You just need to match it, keep your fees low, and give time the space to work its magic. So let's get practical. How do you actually start investing in index funds today? It's shockingly simple. First, you need a brokerage account. Companies like Vanguard, Fidelity, and Schwab allow you to open accounts in minutes, completely online, with no minimum balance. These aren't complicated. You provide some basic information, link your bank account, and you're ready to invest. Second, you choose your index fund. For most people, a total stock market index fund or an S&P 500 index fund is perfect. These funds give you exposure to the entire market with one purchase. Look for funds with expense ratios below 0.1%, the lower the better. Third, and this is the most important part, set up automatic investments. Decide how much you can invest each month, whether that's $50 or $5,000, and have it automatically transferred from your checking account to your investment account on the same day each month. This removes emotion from the equation. You're not trying to time the market or guess if now is a good time to buy. You're systematically building wealth regardless of whether the market is up or down. When prices are high, your dollars buy fewer shares. When prices crash, your dollars buy more shares. Over time, this averages out beautifully. Here's something nobody tells beginners. The best time to start investing was 10 years ago. The second best time is right now, today. Every day you wait is compound interest you're leaving on the table. Every month you delay is momentum you're giving up. I don't care if you only have $20 to start with. I don't care if the market seems overvalued. I don't care if you think a crash is coming. Start now with whatever you have, because building the habit is more valuable than timing the perfect entry point. And here's the beautiful paradox. The less you pay attention to your investments, the better you'll probably do. Studies show that investors who check their portfolios frequently are more likely to make emotional decisions. Panic selling during crashes, greed buying during bubbles. The most successful index fund investors are often the ones who set it up once and basically forget about it for years. They're too busy living their lives to obsess over daily market fluctuations. Meanwhile, the day traders watching every tick are usually destroying their returns with fees, taxes, and terrible timing. Before we wrap up, let me address the elephant in the room. What about crashes? What happens to your index funds when the market collapses? This is the question that keeps people on the sidelines, paralyzed by fear. Here's the truth. Crashes are absolutely 100% guaranteed to happen. The market will crash during your investing lifetime. Multiple times. Possibly catastrophically. Your account balance will drop. You will feel sick watching your money evaporate. This is not a possibility. This is a certainty. And it's also completely fine. Because here's what history teaches us. Every single market crash in history has been followed by a recovery that reached new highs. Every single one. The Great Depression, Black Monday in 1987, the dot-com bubble, the 2008 financial crisis, the 2020 pandemic crash, all of them recovered. All of them were followed by years of growth. The investors who got wealthy weren't the ones who avoided crashes. They were the ones who held on through the crashes, who kept investing during the darkness, who understood that volatility is the price you pay for superior long-term returns. If you can't stomach watching your account drop 30% without selling in panic, investing in stocks probably isn't for you. But if you can embrace that temporary volatility in exchange for decades of compound growth, index funds offer a nearly unbeatable path to wealth. This is the secret that Ronald Read understood. This is the wisdom that made Warren Buffett recommend index funds in his will for his own family's inheritance. This is the strategy that has quietly created more millionaires than any other investment approach in history. It's not exciting. It's not complicated. It doesn't require genius or luck or connections. It requires consistency, patience, and the willingness to ignore the noise. It requires you to trust the math over your emotions. It requires you to be boring when everyone around you is chasing the next shiny thing. So here's my challenge to you. Within the next 24 hours, open a brokerage account. You don't have to invest a penny yet if you're not ready. Just open the account. Remove that barrier. Then, this week, invest something, anything. $10, $50, whatever you can genuinely afford. Make that first purchase of an index fund. Feel what it's like to become an owner of hundreds of companies with one click. Start building the habit. Because here's what I can promise you. If you do this consistently for the next 10, 20, or 30 years, your future self will thank you in ways you can't even imagine right now. If this video opened your eyes to a completely different way of thinking about investing, hit that subscribe button because we're just getting started. Next week, I'm breaking down the exact index funds I recommend for beginners, including some specialized funds that can supercharge your returns even further. Drop a comment right now telling me what your biggest investing goal is, and don't hold back. Are you trying to retire early? Save for a house? Build generational wealth? Let me know, and I'll make content specifically to help you get there. The financial industry has spent a century convincing you that you need them. They're wrong. You have everything you need right now to start building real wealth. The only question is, will you take the first step?